Okay, folks, so today we are joined by Dana Samuelson to talk about investing in precious metals and why it hasn't lost its raison d'etre throughout time. Since the 1980s, Dana has seen over $1 billion worth of gold transactions and founded the world-renowned American Gold Exchange, Incorporated, a precious metals and rare coin boutique in Austin, Texas. Welcome, Dana. Thanks for joining.
Well, thank you very much. Thanks for having me on.
Oh, yeah, absolute pleasure to have you. So first things first, would you say that in the current climate there is an increasing appetite today, 2019, from people wanting to hold precious metals in the physical form?
Yes and no. Right now in the United States, we're having a pretty good economy, one of the better economic situations we've seen in the last 4 or 5 years. And the public has been attracted to the stock market and more traditional paper assets because they're feeling a little bit more confident than normal, they have been for the past 10 years in this particular moment in time. But we are seeing a much bigger trend, which is much more important among central banks worldwide who have been accumulating gold in a major way: China, India, Russia, Japan to a modest degree, but we've seen central bank holdings of gold increase substantially over the last 5 to 10 years, primarily because of as a hedge against all of the paper money that has been created to help the world economies recover from the biggest financial and economic setback in 75 years, the Great Recession.
How interesting, considering that central banks are reflective of the government that are perpetuating the proliferation of printed money, which has been printed like it's going out of fashion.
Exactly, and the paper money has just ballooned incredibly over the last 10 years. The U.S. has gone from about $1 trillion on balance sheets to $4 trillion now. U.S. debt has gone over $22 trillion and rising fast. I think, if I remember my numbers correctly, in 2009, total worldwide debt was about $99 trillion, and today it's close to about $180 trillion. So it's almost doubled in the last 10 years, and it's all paper.
Well, the mind boggles, really. It really does. These are numbers that I'm completely, you dare write $1 trillion down in paper form, and I can guarantee most people listening won't be able to do that, including myself.
Well, it's mind-numbing because the numbers are so big, and people cannot relate to it on a personal basis to these kind of numbers. I think the average debt per person in the United States to pay down the U.S. debt is about $70,000 per person. So I've taken a step back and looked at this historically, and I got into the business in 1980 on the tail end of the first big precious metals boom. Since the U.S. went off the gold standard in 1971 under President Nixon, and the U.S. started printing more money than the U.S. had in gold reserves dollar-wise at Fort Knox. So we created the original modern version of fiat money in 1971 in the United States. And by the end of the decade, and gold was about $40 an ounce at that time. By the end of that 10-year period, when we opened up the printing presses for the first time as the world reserve currency, gold had hit $800 an ounce, inflation was 18%, and interest rates were 18%. What's happened now over the last 10 years is the whole world has done the same thing, which is printed money much more than they have ever done in the past and created much more debt than ever has been created before. But we haven't seen the effect of that printing yet. And I think that, as longtime legendary investor Doug Casey says, when that chicken comes home to roost, it won't be a pretty sight for paper currencies worldwide, which is why gold makes sense for everyone today as the currency of last resort, the oldest and most trusted form of money in the world, basically.
I can understand that, and it's a fantastic hedge against the future, which is unknown. I mean, tomorrow is not guaranteed. But what is interesting, Dana, is gold was actually once legal in America back in 1933 when Roosevelt realized that he had a shortage of it and urgently needed it to cover rampant government spending. Back then, the Fed could not just print money fast enough, as the US law required 40%, I believe, of every dollar to be backed by gold. And who better to steal gold off than the American citizens? Now, this ban was lifted in 1974, if my memory serves me correctly, a few years after the abolition of the gold standard. But given today, if we fast forward to today, given the enormous deficit the US government currently has alongside its bloated national debt, what do you think? I mean, what could stop the government from doing this again to its people?
From confiscating physical ownership of gold?
Absolutely.
Okay, so back in 1933, when Roosevelt was forced to take this drastic move because countries around the world didn't want to take dollars in payment, they wanted gold. So gold was flooding out of the U.S. Treasury in international payment in the form of U.S. old $20 gold coins, primarily into France and into Russia. So to stabilize that, we had to take the gold out of the currency to move to a paper currency to restock the U.S. coffers, basically, and get people off of the gold standard so we could support the money that was being created at that point in time or necessary to stabilize things. So at 1933, gold was money. People had an everyday choice between a paper note of $20 or a $20 gold coin in the United States and around the world. In Britain, British sovereigns. In France and Switzerland, 20 francs, the most ubiquitous gold coins. So Roosevelt made gold illegal to own, and the gold was called in. If you were caught with it and it was using it in commerce or in black market transactions, it was confiscated. Today, let me back up one step. 100% of the people back in 1933 had a choice over gold or paper money. And they wanted the gold, but it was everywhere. Today, maybe 5 to 10% of the public actually owns physical gold here in the United States. And I think it's not money anymore. It's a commodity. So I think the call for confiscation is a bit overblown if that were to happen, because if they were going to do it, they would have done it in 2009, 10, or 11, when we were at the peak of the recent financial crisis, and everybody wanted gold and nobody trusted paper at that point in time. The fact is, the U.S. Mint is in the business of making gold coins today. So they would have to stop a business that they're in and turn around and pull back everything they've already put out. And it would be for a very small segment of the population relative. So I don't think confiscation is as big an issue in modern times as it was back in 1933.
Sure, I understand that. So when it comes to gold, I mean, we omitted to talk about the precious white metal as well. I mean, do you think silver, known to many people, amongst many circles, as gold's emotional sister, given that the moves in silver are generally far more emphasized than gold, even though it's far cheaper in price? Do you think silver is as valuable a commodity potentially to keep long-term relative to gold, even though it costs less per ounce?
Absolutely, and here's why. Gold is real value, high value that you can transport easily. You can hold 100 ounces of gold in both of your hands. It's about the size of a paperback novel in physical form. It's $130,000 at today's market price. So the fear bid is into gold right now because it's an easy way for people to transport and store real wealth. What silver is a transactional precious metal. It's much more useful in daily transactions if we ever get to that kind of an extreme situation. So silver is your spending money if you want to have a little hard money for a crisis, where gold is your ability to transport real value, real wealth easily. $130,000 of silver, you need a truck to cart around. It'll take up, it'll cover a desktop very easily in big physical form. So it's much more cumbersome. And you're right, it does oscillate to a much wider degree than gold does when it really moves. And if you measure gold and silver relative to each other right now, you can see that gold is catching more of the fear bid in the world today based on the gold to silver ratio, which historically for 2,000 years was 20 to 1. When we went off the gold standard in physical gold in 1933, it went up to about 30 to 40 to 1. And today, in the modern times, it's usually between 60 and 70 to 1. Right now, the ratio is 86 to 1, which is about an all-time high, which means silver is cheaper relative to gold than it almost has ever been. So people are buying gold, the wealthy are buying gold to hold it as a way to hedge their own paper bets. Silver is not quite getting the bid that it should. If we go into a weaker economy, or the Fed decides to start easing again, or the world starts to really ease and print more money again, silver will play catch up hard and fast. And it won't be $15 an ounce. It'll be $20 an ounce or $25 an ounce. So proportionally, it can go up much farther, faster than gold does in the current market.
So given that silver is relatively more cost-effective for, say, people who are looking to enter into the world of precious metals investing, do you think it might be an idea for people listening to buy silver with the idea to potentially either holding onto it or swapping it into gold when that gold-silver ratio becomes more favorable?
Yes, that's perfectly. That's a very smart strategy, actually. So silver's cheaper. If you've never bought precious metals before, it's an easy way to get started, to get used to the physical precious metals process. We're a national mail order business, so we do business through the mail with most of our clients here in the United States. And most people are a little leery about sending real money to someone they don't know. They're not buying a pair of pants; they're buying an investment, basically. But silver's a good starter metal. If you've never bought precious metals before, it's an easy way for you to spend a few $100s. Get 20 ounces in 1 ounce form, either from the U.S. Mint or the Canadian Mint or the British Royal Mint. They make 1 ounce silver coins, sovereign minted. You can also buy bars, 1 ounce, 10 ounce, 100 ounce bars. But it's a great way to get started. And you're getting, I think, an excellent value because silver is so cheap relative to gold. We do use that arbitrage strategy at times when the market is at extremes. In recent times, the last 10 years, the ratio has been as low as about 55 to 1, where silver was much stronger relative to gold. And at that point in time, it makes sense to sell silver and buy gold. Right now, it makes more sense to sell a little gold and buy silver, or start with silver because it's so cheap relative to gold.
Yeah, well, that's exactly what I've done as someone who has a lot more faith in precious metals compared to, and this is my personal opinion, cryptocurrencies. And neatly leads me on to talking about cryptocurrencies. Do you find that the proliferation, say, of Bitcoin and other altcoins have challenged flows of money into precious metal investing, now that Bitcoin especially is regarding by some leading luminaries in the industry as a safe haven away from fiat currencies when gold and silver were the traditional ones?
Well, Bitcoin certainly attracted a lot of attention 2 years ago when it was surging up to almost $20,000 per Bitcoin. And to be honest with you, our sales suffered as a result. We had several customers who had big holdings of precious metals, gold and silver, and they dumped some of it to buy Bitcoin. I don't know if they got out at the top or whether they're still holding at big losses right now. But Bitcoin and other cryptocurrencies have allowed people who are independently minded, which are precious metals buyers and holders, to use a currency that's not a government-backed currency and make private transactions amongst individuals. So that is a big draw for the cryptocurrencies. Younger people in particular are much more drawn to the cryptocurrencies than precious metals in the current market. So we've seen a lot of younger people, millennials in particular, who have been drawn into Bitcoin and some of the others. And it is a viable way to trade, but I don't know if they're a good investment yet. The thing that concerns me about the cryptocurrencies is they're eminently repeatable and replaceable. So it's like beta versus VHS years and years ago. Which one is actually going to be left standing when all is said and done? And the governments around the world are competing, as are major companies as well, to create their own cryptocurrencies. So the dust hasn't settled on the emergence of cryptocurrencies yet. I would be very wary of using them as an investment, but as a means to trade privately, yes, it's an excellent way to go, number one. And yes, it has eaten into precious metal sales at times, especially when Bitcoin was so strong. But the fact that it's corrected down so much from its high, down to about 3,300, a little over 5,000 now, if I'm keeping up with it. It has drawn from physical precious metals demand at times, but it's not a replacement for gold and silver, because gold and silver are the oldest and most trusted currencies of last resort. Bitcoin is a good vehicle, or cryptocurrencies are a good vehicle for private transactions.
So gold and silver being the mainstay. I mean, what is interesting about cryptocurrencies is Christmas of 2017, the last trading day, even though cryptocurrencies, or certainly Bitcoin, is 24/7, what was interesting was that the last kind of stocks trading day before Christmas, 2017, suddenly Bitcoin absolutely plunged. And I thought that was this smart money. I had a theory that this was the smart money, the bigger investors quietly pulling out while the rest of the world is suitably engaged with Christmas and the festivities. When you look at bubbles and how they historically formed, certainly Bitcoin in its current form could be classed as a bubble that's just popped. And now people who are riding on losses have that horrible wait in purgatory where they don't know whether they're going to have to realize a loss or a profit. And if they are hoping to make a profit, just not knowing how long they have to wait for that profit must be quite an agonizing wait for them. So the silver Morgan dollar is generally viewed by coin collectors and numismatists as having dual benefit for investors and coin collectors alike. People can both simultaneously own a coin that appreciates in its historical value, and that is of course dependent on the grade of the coin as well as the underlying bullion value. As many of the listeners here are from the United Kingdom, what would you recommend as an appropriate alternative for Brits?
For silver coins?
For silver coins? Yeah, absolutely. Silver or gold?
Well, in Great Britain, we do a big business actually in British gold sovereigns, the old kings, King Edward and King George and Queen Victoria. Not so much the new Elizabeth sovereigns because they're more modern pieces, but Europe. In Europe, things are not considered old unless they're from the 15 or 1600s. Most of the coins that are minted from the late 1700s, 1800s into the early 1900s don't have the equivalent collector value that similar U.S. coins of the same era have, because there's so many different places that they were made. You have 17, 18 countries in the Eurozone, not the whole Eurozone, of course, but that made gold coins up to 1933, 1934, 1935. So you can buy these old British sovereigns, Swiss 20 francs, French 20 francs, Denmark 20 kroners, Dutch 10 guilders, basically at gold value today, and they're historically old coins. There's not as many good options in silver that I'm aware of for old collector coins in Europe. The U.S. market, contrarily, it's a much bigger market for number of buyers, and what was made was a lot simpler. We only had 4 denominations in 2 different designs from 1850 to 1933. When you have so many countries making their own gold coins in Europe during the same period, there's a lot more choices and a lot other coins that are truly rare that are minted from 1750s, 1770s, and earlier, which is really where the numismatic market is in Europe. That doesn't mean that there aren't great collector coins to be owned in the 1800s, but they're fewer and farther between.
Okay.
Does that make sense?
It makes perfect sense, absolutely. I mean, I think a lot of people listening would, apart from the historical value, appreciate the underlying bullion value increasing over time. But the historical value, if it's, say, a hybrid coin where they can increase over time, regardless of the bullion value, based on its historical value, that's the sweet spot, in my opinion. What do you reckon?
No, I agree completely also. We do a big business in the U.S. in old U.S. $10 and $20 coins minted 1933 and earlier. And right now, premiums for those coins, the collector premiums, are as low as we've seen for two reasons. Primarily because we've had a complete reset with the gold price. For most of my career, from 1980 till 2004, 2003, gold was between $300 and $500 an ounce. And these old $20 gold coins that we do a big business in were all worth, double or triple their gold value as collector coins. And now we've seen a reset with the gold price where gold is on a basal level is about 3 times to 4 times what it's been historically at $1,200 an ounce to $1,300 an ounce. So the bullion value of these coins has risen dramatically. And now that we're in a bit of a better economic situation and people are going back into traditional paper assets, more than not right now, the premiums on the classic gold coins have compressed. We haven't quite adjusted for the reset in the gold price in the collector coin market here in the United States yet. When we do, the premiums will go a lot higher than they are right now. So there's a lot of value to be had in the old U.S. $20 gold coins minted in the 1920s or pre-1900 dates, $10 gold coins as well. So I see a lot of value there where you can get a classic historical coin that's had a much higher trading value relative to its intrinsic value today on the cheap for 10, 20% over intrinsic gold content, where in the past these coins have been 80%, 100%, 150% over gold value.
Well, as we are knocking at the door of all-time highs, certainly with the Dow Jones Industrial Average, and we are due certainly a recession, given that it's been 10 years or over 10 years since the last one. Let's see what happens to the prices of gold and silver moving forward.
Well, let me just say one thing real quickly as far as demand goes. It's unusual because we're a little confounded right now in our market because premiums are so low on some of these older gold coins. And I looked back to see if there were parallels in the past, and there are. If you look at how many U.S. gold eagles the U.S. Mint makes on an annual basis as a proxy for physical gold demand in the United States, we've got 3 years where demand for physical gold was very low, as evidenced by the amount of U.S. gold eagles the Mint made, 2000, 2007, and 2017 and 18. Why? All 3 times the stock market hit record highs during those years, which is a perfect analogy for why demand is down. When the stock market's strong, the public doesn't care, and the public chases markets. The public doesn't buy fundamentally on the cheap. They tend to chase markets, like Bitcoin when it went in the bubble over 12 to 14,000 up to 20,000. Or gold when it went from 1,600 to 1,900. The public was all in, just like they're getting into stocks now. So people that buy contrarily can do exceedingly well in the physical gold market right now, I think.
Yeah, I think you've got a very good point. And certainly, what is the old expression? Warren Buffett, the man himself, said, be greedy when people are fearful and fearful when people are greedy. And right now, in certainly looking at equities, there's a massive state of hubris at the moment. And as interest rates are certainly from the Federal Reserve and the Bank of England, they are steadily increasing. I guess this is having an impact on gold, as those people who are holding it as well, they're looking at the percentage fee they are paying per year, and they're also thinking, well, where can I get my money a return elsewhere, even if it's in a bank, even though the interest rates are not particularly high like they were 10, 20 years ago. Certainly gold is unloved at the moment, relatively speaking, it would seem.
Right. Well, gold is an excellent insurance policy for the rest of your money. If you have 5 to 10% of your assets in physical gold, you have a wonderful hedge against uncertainty in paper assets. And if you look at it as an insurance policy instead of an investment, that may be a better way for some of your listeners to get started in their own minds as to how to wrap themselves around it. You have a car insurance policy, a house insurance policy, health insurance policy. You have to keep paying the premium every year. You got to write a new check. When you buy gold as a hedge, as an insurance policy for yourself, you pay the premium once, and most of the time you're going to get 80 to 90% of that premium back, or 150 to 200% of that premium back if you ever really need it.
Well, there you go. Dana, thank you so much for your time. For those people who want to find out more about you and what you offer, where can they find you?
Okay, so I'm president of American Gold Exchange Incorporated. We're in Austin, Texas. We're a physical precious metals dealer specializing in modern bullion coins minted in the current era, and also classic pre-1933 U.S. gold and silver coins, as well as some of the European gold coins I mentioned from the same era earlier, British sovereigns, French and Swiss 20 francs. We're in Austin, Texas. Our website is www.amergold.com. It's a information-rich, fully transparent website for pricing and availability of products. We're very competitive. We're very user-friendly. Our phone number is 800-613-9323, and anyone that wants an information package can email info at amergold.com, and we can send information to you that way.
Fantastic. And the link is at the bottom of the article as well. Dana, thank you so much once again.